This short clip is presented by Hedge. Hedge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Hedge, visit www.laductrading.com/edge.
Hey, greetings and good afternoon. I'm Samantha LaDuc, founder of LaDucTrading.com, with our macro advisor, Edge manager, Craig Shapiro, who you just missed, picked up his cat and moved him or her off the camera. Too funny. Craig is traveling, so I'm just really grateful that we can get him on the hot seat and not only talk about the market, but also Trump odds and what the market may or may not be pricing in, which is a little bit tough. There's the cat. Stella will make a cameo, at 5 o'clock when it's time to feed her. So the hedge fund factor rotation has been a theme that we've been talking about the past few weeks. And in fact, this concentration risk unwind. So it's here, it's now. How long it lasts from this forced selling is, of course, the $1 trillion question, because that's how much at least has been unwound in just 1 week. Since smalls basically beat large cap. So let's just kind of back up a little bit, since I know you are kind of chomping at the bit with all these headline risks of conventions and Biden exiting and let's get your assessment of the top macro risks right now and where you see the market going from here.
Yeah, I mean, there's just so much going on, and I think we articulated, a variety of times about how important options are and options expiry, and what that means, where we are. So clearly, this is an expiry week, and I think with respect to what we've seen over the course of the last week or so since the soft CPI print, is we've obviously seen a tremendous unwind that has taken place, and we've talked about and captured a lot of the long NASDAQ short IWM trade and saw how, extended that got. And look, you just never know when it's going to end. And then when it ends, it often ends violently. And so, really what we got last Thursday was, I don't know, a reasonably expected, weaker than expected CPI print, but for whatever reason, really solidified the idea of the September rate cut. And so the kind of got this algos gone wild dynamic where small caps and most short names and junk and garbage really just started to get covered and started to go. And
just to clarify, that print was actually the first negative one since May of 2020, and it actually spurred a 100% chance of a Fed rate cut in September. So it really did give a lot of fuel for the short covering rally.
Yeah, and it was violent. And so that was Thursday. And then on Friday, PPI came in a little hotter than expected, and it maybe took a little bit of the wind out of those sails. And then so on Friday, we had a reversal back, and NASDAQ really had a big day on Friday. And so I think some folks would think, okay, that was just a 1-day unwind on Friday. And then we kind of walked into this week, and then the unwind just went further in, call it Monday and Tuesday and into yesterday. And we got to the point, I think on Tuesday at the close, where IWMs were 4.5 standard deviations above the 50-day moving average. And we were talking about, historic outperformance in a very short-term period for IWMs versus NASDAQ. And look, and we know that everybody is long or has been long big cap and mag 7. And so, as they start to cycle out of some of those trades, that the question that we're faced with is, do we get rotation into other things, or do we just get net selling? And it had been my view that fundamentally, I didn't really see a reason why we would get a rotation out of big cap tech into cyclicals, small caps, economically sensitive sectors, because the economy is slowing. And my view is that earnings momentum has rolled over, and the Fed is going to be slow to react to that environment. And so I didn't think that there was a fundamental case for the rotation. That being said, you don't really need to have a fundamental case when you have positioning as stretched as it had been, and you are moving into an expiry week like this week. And so the amount of call buying that we had over the course of the last 5 days in IWM, I suspect is also record.
It is.
2+ million calls every day for the last several days, such that yesterday I had pointed out that the Russell Vicks was actually, on a big move up in Russell. Russell Vicks was up like 10% yesterday. So it was a clear, grab and hope for outperformance, or hope for FOMO of chasing. And so, but the question that I was thinking about is just, well, when is this going to stall out? It's obviously, very, very difficult to know. But some of the things that I was looking for were this golden most short index had kind of gotten to the 99th percentile of overbought on my indicators. That's usually a good place for that to stop. And today it was down 3.5%. So I've kind of been noticing that yesterday. Secondly, implied correlations, and I posted this in our channel, and I put this on Twitter. Implied correlations have made a bottom really over the course of the last several days, and had another big move yesterday and then again today, which to me suggests that we're likely unwinding some of the late entries into these dispersion trades that we have. And so just kind of adds more fuel to the potential for pain as we move higher. And so and that performance of IWM versus S&P, versus Qs or S&P, had really kind of got into some overhead resistance on the on the relative chart graph. So my view is I thought today was probably going to be either today or tomorrow. Tomorrow being expiry would be the end of that alpha unwind move. And then so what I think is that alpha unwinds beget beta face plants, right? And so because when you get this kind of pain in an environment where liquidity is being withdrawn, I think that what we're going to have is the underperformance of lately on the underperformance of late of big tech is going to drag down all of the indices, as opposed to now these overbought readings for Russell dragging everything else back up again. So I was looking for a top, really yesterday or today or Monday, and and after looking at the trading today, I feel kind of more confident in that shorter term view. Now, I'd say the earnings are a big part of this. Earnings have to come through in order to get that positive rotation be sustainable and have the markets continue to move higher. And I think what we saw from the early part of earnings season was not really great cyclical earnings. Now it seemed like even the bank earnings weren't that great. The initial reactions, for most of the banks were negative. Then they got kind of picked up in some of this laggard trades, and so they did okay. But some of the other more cyclical names like a JB Hunt or some of the airlines or some of these more domestically oriented cyclical names, the home builders, the numbers weren't really that good. And so I think as we get more of that weakness from earnings, folks are going to say, why am I thinking about rotating into laggards, into value, into small caps, when the economy is rolling over, earnings momentum is rolling over, and the Fed is going to be slow? And I think that reality is going to be borne upon us over the course of the next couple of days and weeks. While we have systematic flows as long as they've been in the last 5 years, we don't have share buybacks to a large degree, at least for the next 2 to 3 weeks. And start as of tomorrow, a lot of the gamma and a lot of the expiry dynamics kind of move off the board, and so we re-enter this window of weakness potential. And so then we have the Fed meeting. Next week we have a lot of duration issuance. Janet is selling 2s, 5s, 7s, and a ton of bills. And then the following week we have the QRA and the Fed, neither of which are likely to be a positive surprise, right? The Fed is not cutting in July. The market's already expecting them to cut in September. It's hard to see how they could be more dovish than what the market's already expecting. And then with respect to Yellen and the QRA, No one is expecting duration issuance increases. And I think that makes sense because that's what she said as of the last QRA, not to expect any more increases. Although since then, the budget deficit is up 400 billion this year. And so their borrowing needs are more. So look, they're going to issue more bills. They should be issuing more bonds. But I don't suspect there's any chance that they're going to issue less bonds, which is what would be the positive catalyst. So without those liquidity additions coming, I feel like we have a really tough outlook here for the next days and couple of weeks.
So we have obviously the backdrop of this rotation, which has been front and center. Also, the Trump assassination attempt, which just skyrocketed him in the polls. Some are giving credence very heavily to a Trump presidency. Nothing is a done deal, but kind of contributing some of this value rotation on the heels of policies that would be very supportive of U.S. businesses and devaluation of the dollar, which is also kind of market bullish, but not for large cap. He necessarily doesn't have a lot of fondness for some of those CEOs. Did make some motions also during his first term to kind of tap down the enthusiasm around those monopolies, but nothing really happened or changed. So now the timing of the hedge fund factor rotation, which is that short covering of oversold value, and junk, to the overbought, I should say, selling of the concentration risk. We've seen this with also the Trump impetus in the polls. Do you see any kind of weight that you give one over the other? I know you're expecting smalls to come back in, but bigger picture, we kind of need to talk about this Trump presidency and the policies, because this is already getting a lot of headline attention, especially with the Biden exit headlines, which are rumors, but the risk is clearly there. And was one of my top 5 bets for this year that he actually wouldn't make it to the ballot. So anyway, this is something that I'm kind of curious where the weighting comes in for the Trump market bent.
Yeah. So look, since the debate, right, at the end of June, the odds of Trump being elected and the odds of better Republican performance and a potential for a Republican sweep have been part of the momentum in the trading narrative. And what we had seen, were curve steepeners, because Trump is seen as somebody who is running more inflationary type policies, right? He's going to kind of force the Fed to cut rates, bring the short end rates down, but he's going to cut taxes and bring on tariffs, which are going to be inflationary, which is going to bring the back end yields up. That's your curve steepener. As far as the inflation is concerned, gold has done well, because of Trump, on that view. Now, Trump is also now seen as the Bitcoin candidate. He's made some comments about possibly using Bitcoin or as a strategic asset for the government. I mean, there's plenty of rumors going on, but there are crypto and Silicon Valley advisors now, whether it's a Peter Thiel or now with JD Vance and his crew, that are pro-Bitcoin disciples, and clearly that is making its way into the Trump administration, or the Trump platform. I'm going to the Bitcoin conference next week. I was going before Trump was announced as speaker. Now he's going to be there as well. So it'll be a serious circus while we're there. But that's next Thursday and Friday. I forget which day he's speaking on it. But
with or without the cats.
The cats will not be coming with me
to
the conference. But and then as far as the dollar is concerned, look, I think he is going to be I think he would like to have a weak dollar. He has said, the dollar is overvalued. He wants to bring back manufacturing jobs to America. And so I think he could be considered a weak dollar president, and maybe will do things that would, help bring the dollar down. That being said, between now and then, if you're a foreign government, this is coming. My view is you're going to try to weaken your currency materially between now and when Trump gets in there, so that you're in a stronger negotiating position when you ultimately have to deal with Trump and the tariffs. So, so I think that is makes the dollar a little bit more of a challenging call in the near term. And then I guess, equities over bonds, and he's seen as more of anti-big tech. And so maybe some added tech into small cap. So the Trump momentum was part of this unwind. And then on the weekend, he gets, almost gets killed, but doesn't. And so then it's like, well, now there's no way he's going to lose. And so all these trades, I think, really went into overdrive this week. But right now it's July. He gets in there and he gets to get elected in November. He doesn't get into power until the end of January. It takes a long time to do any of these things, right? I mean, so as far as the economy is concerned right now, I just don't see how there's really, going to be any impact from a Trump administration being in there in January right now, because I think consumers and corporates are thinking about this uncertainty about our political system and about whether or not he'll win or not, and are thinking, you know what, maybe this is a good time for me to not make big purchases, or a company not do a lot of hiring, not spend a lot of money on CapEx, because clearly, there are different sectors that are winners versus losers depending on if Trump's in there or not. So I think we're moving into a period here where outlays from individuals and companies are going to slow down, and they've already been slowing, and the Fed is going to be slow to react to that. So for me, this all feels like a growth air pocket, that a lot of uncertainty is going to come back into the country and into the economy as we wait and see whether or not it's going to be Trump versus Biden, or is it going to be somebody else? Now, rumors today were that Biden was being pressured by Obama and by Pelosi, and that by the weekend, he's gone. And look, in my view, Biden is the absolute worst candidate for Democrats. And so if he leaves, the odds of Democrats winning go up. So some of the Trump trades will be unwound. And I think a little bit of that was back in the tape today, because small caps were down 175 basis points and NASDAQ was down 45 basis points. Most short index was down 3.5%. Momentum index was up 150 basis points. So you saw a little bit of that kind of move back into what had been working before. Now we'll see. It's obviously expiry tomorrow, so who knows if this will continue. But even if, look, Harris doesn't give Democrats a great chance, but it's a better chance than with Biden. So, and really the key, I think, for Democrats is can they keep, either the House or the Senate, and running a stronger candidate at the top of the ticket with maybe a stronger VP, whoever that might be, increases the odds of doing that, which lowers the odds of Republican sweep, which is something that has been in the pricing of markets. So I think it's too early for these narratives to really be materialized in markets. I don't really think real money is plowing into any of these Trump trades at this point, given the uncertainty. So now I think we're back to it's going to get increasingly uncertain into a period of time in the calendar where seasonally we typically get consternation and chop, and often sell-offs. The August to October period is littered with drawdowns and sell-offs and risk off as we get.
July 17th is usually the bottom in Vicks, and so we absolutely
we nailed the absolute timing. Yesterday was the Vicks expiry. And look, these timing analogs matter because of options, right? And because of expiries, and because of positioning every month or every quarter are bigger. And so these types of flows are important. And so that's my concern is that we've run markets very hard into the middle of the year. Where the incremental flow is going to come from in the middle of July through the middle of October, when they typically don't come into that seasonal weakness, while systematic flows are already very long.
And many are on vacation and don't come back until September, so it's thin and easy to spin it.
Yeah. So look, I think that's a precarious setup here, and so I don't think and you're still getting paid 5% plus to be in cash, and that doesn't seem like it's going to go down rapidly anytime soon. So no risk on reinvestment to kind of put your money into 1 month or 3 month bills
with all the election uncertainty.
Yeah, so you just kind of wait it out.
With this Trump theme, and by the way, this is open to Q&A, everybody. So if you have any questions, just hit Q&A. corporate profit margins. Let's talk about that. Should Trump advance team, get elected and into 2025 and beyond, what's the impact, your initial assessment on corporate profit margins, since this rally has run hot and heavy on growth momentum, pulling forward a lot of AI, tech ecosystem demand. But the point is, it has definitely now appears much more likely that Biden exits and Trump's increased odds will have an impact on forward earnings. What's your initial thinking about that moving into the new year?
Yeah, I mean, it's really hard to know about look, Trump, we all lived through Trump's presidency and the chaos of it, and the changing of the cabinet and firing people and changing directions and the like. And so I think it's very difficult to know exactly, what his policies are going to be. Now, Bloomberg obviously had a piece earlier in the week that went through, a litany of policy prescriptions, which were, obviously he's an immigration hawk, right? So the border effectively is going to be closed. So what does that do? That's going to lower labor supply and it's going to drive up wages, in theory, which should be inflationary. He is very likely to use tariffs as a negotiating tool, probably from day one, and very much against China. So he has talked about a 10% across the board tariff on every import, and maybe taking China tariffs back up to 50, 60%. So that seems like, a very high likelihood thing that he is going to do early on. He also kind of in the throwaway comment mentioned it's not clear to him that the US should be supporting Taiwan anymore, given how much Taiwan has, in his mind, taken the chip industry from us, and they should really, be paying for our defense. And I don't know if he's right or wrong, but, it's been our policy to defend Taiwan for a long time. He could throw that policy out the window. And that's a really important dynamic, uncertain, but it's a really important thing because chips are obviously, hugely important. And from an AI perspective, if China were to move on Taiwan, I mean, and NVIDIA and all, it just, chaos, right? Chaos would ensue. As far as the tax policies, I know you get into margins, but the tax policies, he said he'd like to move, tax rates down to 15%. Now, that would really help small caps because small caps are the ones that actually pay taxes if they have profits, whereas like big cap doesn't pay taxes already anyway. So on the margin, that would be better for small cap net profit margins if they're paying less taxes. But if they have higher wages, then maybe there's, also, some offset. But the problem is that you have very disparate people being rumored to be part of Trump's inner circle, right? You have JD Vance and Robert Lighthizer, who are, kind of America first, folks who are big on domestic manufacturing or weak dollar. They want to be mercantilist on trade. They're anti-globalist. Then you have, people on Wall Street who are being rumored to be part of the administration, whether it's, Scott Bessent, who's a hedge fund guy, John Paulson, who's a hedge fund guy, Ken Griffin, who's a hedge fund guy, Jamie Dimon, who have all been rumored to be possible Treasury Secretary candidates. It's really
Dimon has already said no.
but the other three are Wall Street guys. So to believe that Trump's going to be this populist president and try to hit the stock market to help move money from the rich to the poor and to the working class when you have a Wall Street Treasury Secretary, I don't know, doesn't really.
We've been there, done that.
We don't. So look, I think we could.
We did this with Mnuchin.
Yeah, we could go back and we could look at what happened during his first presidency, and he blew out the deficit massively, and wealth inequality went to egregious levels, and that's obviously continued really under this administration. Both. So it again hard to bet in July about what that world looks like in 2025. And so I don't think they're going to.
But the donors are very clearly contributing, including Griffin and Musk and others. So he's, it's all very beneficial to him gaining more momentum in the betting odds. But as it relates to, like you just mentioned, this globalization, we have been exporting our inflation for 40 years. That reversal isn't really talked about. It's just a really nice hillbilly effigy to talk about bringing jobs back, but it actually is very inflationary. That doesn't seem to make the other side of the equation, because that is needed. And no talk about how productivity is going to need to outpace, these higher costs and wages. So where do consumers, come into play on their spending? That will feed directly into corporate profit margins. So we really don't have the answers to that, right? So there's the talking points of all those he will appoint and all the policies that he will enact. But honestly, 40 years of very entrenched, exporting of deflation is not going to turn around on a dime just to onshore in a one term.
Look, I think that what we do know, or both gold and I guess maybe to a lesser degree, Bitcoin are, sniffing out whatever this new world is going to look like, which is going to be deglobalized, which is going to be more inflation, multiple supply chains, a Western supply chain and an Eastern supply chain, one filtered around the US, one filtered around China, much more inflationary, much more debt for the US, which is, and I think that's what gold is, partially been sniffing out. That's why gold's at the highs, now, and Bitcoin's largely, a derivative, of that. And so I think no matter what, it's very hard to see Trump being anything other than a inflationary president and a deficit building president.
How will he build a deficit? Because we've already got the, the Inflation Reduction Act that he says he's going to unwind, but those programs are kind of embedded for 5 years as far as allocations and such. So, I mean, what additional deficit building do you see?
I mean, really, the biggest one is that the CBO deficits that are budgeted in assume a return of the old tax code starting in 2026, and so, because the Trump tax cuts expire and they go back to the old levels, no matter what. That was I think whatever it was, a 10-year deal. So that's over. And so if he's in there, he is going to push aggressively for an extension of those. I think it would be impossible to see tax rates go back, to those levels. And so that is a big hit on tax revenues. That will, help blow out the deficit. Now, partially, that could be offset by, on the margin, will there be some discretionary spending cuts if he gets religion about chopping, or cutting the fat in some of the, parts of the government? Yes. But really the bigger variable would be, can he get the Fed to lower interest rates on bills?
But he did this
I don't know
during his first term. He browbeat Powell every day, and look, very successful.
And look, I think if he somehow is able to get the Fed to cut rates and without spawning a resurgence of inflation, that's how he could offset some of those tax increases. And he's also said that if we bring in these tariffs, that's more revenue for the government too, right? So that's his logic about it. I think most economists.
But that one area has been picked apart, and no one has said trade tariffs are good.
No, look, I think
for economic growth, they actually are the opposite. So he can say whatever he wants, and people,
right? So I think the market is saying. I think the market's figured out, like, deficits are going up, whether either guy is in there. And that's really, not something to. So ultimately, I think if and when Trump is in there, the long end is going to really start to sell off, and we haven't seen it yet because people are, I guess, more concerned about growth momentum deteriorating, and there's been a bid for bonds, but I don't know. I mean, I would never lend the government money for 30 years at 4.4% or whatever the numbers are, are right now, 4.2%.
We do have proof of global credit demand falling from rate cuts that are already kicking in other central banks. So whether it's politicizing that role, or whether they're just preemptive, or they're really having some credit demand strains. Even the bank lending reports so far, even though the market reacted very positively because they beat, the long and short of it was they clearly said the corporate and personal lending is slowing down. So big picture, Fed rate cut, globally, central bank rate cuts, they are indicative of credit demand falling. That will, obviously put support in bonds. But for how much is the question. Citibank, thinks we're going to have 8 consecutive Fed rate cuts. So that's where one side sits. And then you're talking about the longer end moving higher on supply issues mostly, or there are other considerations?
Yeah, it's mostly on supply. And look, I mean, Yellen has no ability to really cut duration issuance. It's really would be irresponsible as well, just given term premiums are as low as they are, really still basically negative. So I think there's really no ability to cut the duration issuance. Now, look, they can move a little bit out of 30s and 10s into 2s, 5s, and 7s, which is what they've kind of been doing, but it's still they're issuing securities that money market funds can't buy, which is the key. So that's duration. So that's, and then I think as far as foreigners are concerned, look, I think there's a belief that, well, Trump's just going to get in there and dictate terms on everybody and make everybody do whatever he says. I mean, the game's a little bit different now versus when he got in there in 2016. I mean, the BRICS are a bit more powerful. The RMB is definitely being used more. Russia is trading away from dollars, already. It's pretty entrenched. And so I don't know how easily he's going to be able to move everybody to his direction. And I think if you're China and if you're Japan, Korea, whoever may get into harm's way of him about having weak currencies, well, between now and then, you're better off if you know a 10% tariff increase is coming. You should probably devalue your currency by 10% between now and then, so that when the 10% comes, you're in no worse place. So I think there is a big case to be made for dollar strength over the course of the next 3 to 6 months as countries around the world anticipate life under Trump. And if you want to have a negotiation with him and he wants you to eventually weaken your currency, strengthen your currency, you're probably going to want to do that from a much weaker level right now, which kind of gives you, more economic support, for domestic growth at this point. So I think
what do you think of his comment in that Bloomberg interview where or in and around that Bloomberg interview where he touched on a wide variety of policies? He also said, Powell better not cut until I get in office.
Yeah, I mean, look, he's had a storied relationship with Powell. He's the guy who did renominate him, and then he, basically said he can't putt straight. So look, what he said in this interview was that there's been rumors that he's going to eliminate Powell, like try to eliminate him from day one. In this article, he said he will let Powell serve out the remaining term as chair, which is through May of 2026. And then so at that point, Trump could put in his own chair. And if there are no slots on the Fed, he would have to promote, I believe he'd have to promote somebody who is at the Fed. If a slot opened up, then he could, bring someone in from the outside. Powell's term as a governor is up at the end of January of 2028. It's not clear if and when Powell is no longer the chair, if he's just going to step down entirely. He may just say, you know what, like, I'm not the chair and I'm leaving early for 2 years, and in which case then Trump could bring someone in from the outside to replace Powell as chair immediately in May of 2026. So, but yeah, look, I think in the article, he also said the Fed really should not be cutting rates before the election because that would be considered a highly political decision, and the Fed should not be part of politics. Now, you could argue the Fed should be cutting before the election because they're not part of politics, because the economy needs a rate cut. So, but look, I think, Trump is, savvy with respect to dealing with the Fed, and he wants those rate cuts when he gets in there. He doesn't want, those rate cuts to start before him and potentially lower his odds of winning. So, that I guess he makes those comments like that. But yeah, look, I think we can anticipate that he is going to browbeat the Fed from day one. Right when he gets in there, he's going to be banging on Powell's door saying, it's time to cut, it's time to cut. And, it's just going to be annoying to have to deal with, for the Fed to have to deal with a president who is, abrasive and, threatens their independence.
All right. So we've talked a little bit about corporate profit margins, economic growth. Obviously, that will be very telling as it relates to unemployment. We're almost up at that 4.2%. We've already unemployment rate. We have already fallen below the 4.2% in the 10-year. And just to answer you, Derek, yeah, I still see this heading 4%, maybe an overshoot to 3.9% this summer. But then Trump would be a reason for higher inflation and higher yields later. But we have to get there. So let's just do this, Q3 business now, which is definitely in play. The MOVE index, softening, the 30-year yield softening, my warm summer housing market call, and all those, stock picks, even before this XHB housing ETF went hot fire flames because of the value rotation the past week. They were doing fine. So anyway, we'll see if that can continue. What about the antitrust focus? Just for you to comment on that. I know you kind of touched on it a little bit, but with so much capex right now going into AI focused endeavors, it would assume less for stock buybacks. And then, of course, getting in the crosshairs for these monopoly breakups didn't succeed under his term, and Biden hasn't either, by the way. And they both, talked a good talk. What's the outlook for, and specifically for the kind of Mag 7, mega cap tech plays moving forward? Where is the bullish story if we have a Trump presidency?
Yeah, I mean, the bullish story is for Mag 7 under Trump is that it's just, the US economy is going to be doing great, and hiring is going to be back, and CapEx is going to be there, and the economic environment deregulated. People are going to get excited about investing in America, and so it's going to be kind of just equity bullish. And Mag 7 is still a decent, is 30% of the index, and so as long as money's flowing into equities, it could be bullish for Mag 7. As far as outperformance versus other sectors, it's probably not. It's probably hard to see an environment where Mag 7 is an outperformer structurally under a Trump regime, because I think he has said in the past how these big social media conglomerates are out to get him, and so
he's not wrong.
Look, the big cap tech, it has a disproportionate share of influence in America, and is clearly undertaxed and clearly underregulated already, and is destroying small business in America. So there is I think a good argument to be made for not necessarily about breakups, but just more, more regulation, more taxation, maybe taxing them on data, taxing them on information, trying to help supplement the deficit that way. Unfortunately, he's doing it because as a vendetta, like he doesn't like Jeff Bezos, he doesn't like Zuckerberg. I mean, in the beginning, he didn't like Tim Cook. Now he likes Tim Cook again. Obviously, he likes Elon now. He doesn't like
Elon's contributing 45 million a month.
He doesn't like the Google guys. He doesn't like the. So I mean, it's a little bit ridiculous that this is what we're talking about, like a president who holds personal vendettas against companies. But this is the environment that we have.
But we have low interest rates and taxes coming, so that's the bullish backdrop in a nutshell.
Yeah, exactly. So, and these companies are, still going to be generating a ton of cash, but valuations are high, right? And there's been a lot of discussion from street research and from DC research lately about AI and about AI profitability and AI momentum and whether or not the hype is real.
Timing. Yes, yeah, they really did ring the bell.
They did, right? You had the Barclays note, the Goldman note, the Sequoia note. There was another big thread, a tweet thread. I forget.
And Dan Ives.
You guys are kind of all coming out at the same time and saying, let's hold our horses here. So, really tough to know. But look, all this stuff seems overvalued. I think they'll eventually grow into their multiples, but could be a situation that looks incredibly similar to 2000, where, in 2001, where we had, a tech stock correction on valuation. And eventually a lot of these stocks grew into their multiples, but it took a while.
Okay. Well, let's go and see what we got for a few questions because
I see someone in here ask about, can the president dictate tariffs? Yes, that is the something that the president can do without
and he did already
without Congress. There's various sections in the tax and tariff and trade codes that the president can authorize kind of unilaterally. He can, justify it on various different sections about national security or whatever. It's pretty vague, and he can basically kind of do whatever he wants on that front. He did it the last time, and I suspect he will.
Just take a look at the chart of U.S. Steel. That literally the day he announced that he was going to be charging tariffs on China, that U.S. Steel literally topped and rolled over, has not made that high. So this is it impacts U.S. companies as well. So it's not just China companies by any stretch of the imagination. Okay, so sorry, I missed, what was the other question? Dictate tariffs? Absolutely.
Yeah.
We still have, debt and servicing of the debt. I don't think there's too much of that that's going to change as Fed and Treasury are still trying to inflate the debt away by keeping this kind of higher for longer. At some point, that narrative will start to unwind if we get closer and he does get elected. I would think that 2 years going to, come down quickly below that 4.2%, which is another level I'm looking for. And bonds will catch a bid. Any comments there on, spending cuts, globalization, deregulation? We got to talk about deregulation.
Look, I think there is a case to be made that he's going to look to deregulate the energy industry and try to bring more calories out, which will be good for oil service companies. And is it going to be good for the oil price? I mean, if the U.S. is returning to spending on drilling, I don't know. I don't think Trump wants a high oil price either. And so, but this is, deregulating the energy industry allows him to better negotiate with Saudi Arabia, who, he says he speaks to MBS all the time. That's one of his buddies. So, we'll see. As far as deregulation in America would be a good thing. I think it'd be good for CapEx. It'd be good for job creation. It'd be good for infrastructure. And hopefully, that happens. I think it'll be deregulation on anything that's not tech, and then maybe some regulation on things that are tech. As far as globalization is concerned, I mean, we are going to move into more of a deglobalizing world under Trump, and it was happening already when he started. It increased under Biden, and it's going to continue under Trump and under Biden, right? With the CHIPS Act and other spending bills to try to make more products at home. I think that's only going to continue. I suspect there will be more tax incentives for domestic investment and maybe higher taxes if you don't do it. So I think Trump wants to negotiate with everybody, right? He wants to negotiate with other countries. He wants to negotiate. There's a story in the Bloomberg piece about how he negotiated with Apple in his mind, right? He basically was very tough on Apple. And then Tim Cook came and said, Mr. President, can I come visit you? And so he came out, and Cook said, look, these tariffs, we can't have these tariffs because they're really hurting us, or China's going to enact retaliatory tariffs. And Trump said, well, make some iMacs in Texas and you'll be good. And then so Cook's like, yeah, sure. And then the story is like that. Then Tim Cook sent him an iMac, right? And now Trump's happy and he likes Apple again. I mean, again, it's ridiculous, but this is how he governs, right? He wants these CEOs in his office where he can make deals. He likes making deals. And so if you're a CEO that has the ability to get in the room with Trump and ask for something and get something in return, that's typically going to be good for you. And so there are going to be companies that will benefit from their relationships with the president, and what he could do for them. And if you're a CEO who despises Trump and has no ability to get in the room with him, that's probably a case for underperformance. So, that's the world we'll be getting into. I see this comment here about this article that Stephen Moore wrote. I didn't read it, but Stephen Moore is, a Republican talking head, and I think making comparisons on inflation and debt between Trump and Biden, saying Trump is superior versus Biden. I think they're difficult to make because of how COVID kind of played out.
QE
and so
that balance sheet, it goes up, inflation goes up. It's
I think Trump was bad for inflation. Or Trump was not So Trump was okay-ish, bad, not great for the deficit, right? And then when the deficit during COVID, the deficit blew out. Not exactly his fault. So kind of hard to really ding him for deficits. And then inflation, was muted because we went into a deflationary bust while the whole country shut down. And then as the country reopened, when Biden became the president, obviously goods inflation roofed. And so, to blame Biden for the inflation kind of doesn't seem right either. But broadly speaking, these deficits are causing inflation. Trump exacerbated the debt and deficits. Biden is doing the same, and Trump is going to do it again. So none of that is good.
Yeah. In respect T regarding, it's not really fruitful to consider a Trump presidency in July. We're trying to kind of unpack this because it is being headline driven, no question. I mean, when I was focused on this rotation, if you recall the past few days, if you follow me on Twitter, I mean, I was really focused that, this rally in smalls, meaning this value rotation, small cap, dash for crap, short covering, whatever you want to call it, was first and foremost hedge fund factor rotation. I really, really firmly believe that because I have tracked that for years. I sniffed this out last Monday. I started talking about it in my live trading room Monday and Tuesday and posted about it Wednesday, Thursday, Friday. And then Trump had the, assassination attempt. Also, Craig has talked about this correlation at all-time lows. That was just begging to revert, right? That chart that I showed you very, very much at the beginning. Let's not forget that we had a breathless rally in growth that was due a pause and profit taking into the earnings season. All of this is like the perfect storm. And then at the same time, Trump POTUS, as president, pumping up in Vegas odds. By the way, none of this would have been incredibly electric as it relates to this rotation being historic. I mean, it has never, ever, ever happened like this, ever, if we did not have dollar and yields also falling. Period, end of point. So I'm really, I'm convinced of this. So we had a short covering squeeze. Yes, it can be the start of a trend reversal, but, and this I, wrote whenever I wrote this, was July 16th, right? For right now, it was just a standard deviation move of size. And I did write also, it would likely trigger more tech selling, but we have, we have a ways to go. But Trump is definitely in this discussion. So I think it is very a good thing to be talking about it, honestly. All right. And then the other kind of point of Dems can change. That's true. Second term won't be typical. That's true. RFK, Robert Kennedy, definitely being considered more. I actually started following this very closely from Pippa Malmgren, and she has been writing about this for many moons, long before he got the football, the Super Bowl ad that went mainstream and announced his, billionaire VP. The point is, this has been building grassroots level. 50% of those registering to vote are independents, and lots of folks are seriously, he's trending. There's no question about it. But it is still worth discussing Trump because we've had nothing but headline after headline of what Trump says and then being attributed to the market. I still think it was hedge fund factor rotation personally, but it helped. All right. Any kind of follow on the insights, Trump versus Biden, on any other, policy gurus, mentioning Peter here. I can't pronounce his last name.
Yeah, he's
thank you.
Yeah, look, I like Peter. Look, I think, again, yes, it's true. Trump had a vision for, America, and the truth is Biden has employed various, parts of the Trump agenda in his policies, trying to bring back jobs to America, trying to focus on the working class, being a hawk on more of a hawkish on trade. Trump put the tariffs in. Biden kept the tariffs for 4 years. I mean, so he didn't really move in that much in a more globalist direction from that regard. But both of them are going to blow the deficit out even further. And so from that perspective, they are very similar. Now, it's just about who gets the money, right? If in the Republican regime, it's about tax cuts. So the wealthy get the benefit of that. And if you have tax cuts with tariffs, then middle class and poor people are going to get screwed even more, because they're the ones who have to pay higher tariffs, to get goods. And now if Democrats are in there and it's more higher taxes but social programs and social spending, then from that perspective, assets could get hit, and so you could have some redistribution of wealth the other way. But yeah, both of them are going to be bad for the deficit. Both of them likely will lead to higher yields in the long end. As far as immigration is concerned, that obviously has a big impact on labor supply, and so clearly letting a lot of people in, over the course of the last couple of years has been bullish for labor supply, has probably kept wages even more muted maybe than they otherwise would have been. But now it seems like Biden is moving in more in a hawkish direction on the border, and Trump's going to move in a very hawkish direction on the border. So would anticipate that my immigration slows down, and that's going to be bullish for wages. But it's also, not having those incremental people in the country also lowers demand for goods. And so that could be kind of a stagflationary impact there, where wages move up, but we don't get the kind of an incremental growth dynamic in play. But yeah, look, to the question, it's July, right? I mean, it's very difficult to kind of trade on geopolitics and American elections in July, with so much uncertainty. And again, I think what's more likely is that the uncertainty that we have is going to manifest itself in reduced consumer spending, reduced corporate spending, reduced corporate hiring, and likely exacerbate the slowdown that's already been months, if not quarters, in the making because of the tightening of monetary policy. So I think it's becoming more likely that we'll get a harder landing that will not be easily solved by 25 basis point rate cuts. And look, I think if you're the Fed and you're anticipating or you're seeing the potential for a Trump regime that looks highly inflationary, how aggressive do you want to be cutting rates, ahead of that, if you think that next year's inflation is going to look a lot higher under Trump than not? And so Trump getting elected may be something that actually makes it harder for the Fed to cut rates. And so I think the Fed is trying to start a cutting cycle, not just do a cut, right? Like if you look at Europe did their first cut last month, and now they're talking about like they may only do one more cut this year. It was like total, like it was like a waste, right? It's like the Fed doesn't want to just do a cut. They want to have a cutting cycle where they could cut for a period of time and then get rates back to what they perceive to be something that looks more like normal. And so if there's risk that they start to cut and that they would have to stop earlier, that inflation will reaccelerate, they don't want to do that. So this is why they're waiting to start. I think we're there, right? I think we're at the point where September is basically a done deal. I mean, we would have to get, a real hot, inflation print for the month of July that we learned about in the middle of August ahead of Powell's Jackson Hole speech. It would have to be incredibly firm in order for the Fed to not tee up.
It's not expected.
Right. It's not expected. Exactly. So
okay,
we have to get that in order to tee that up.
Let's tee up this chart. So this is the 2-year U.S. Treasury yield, right? Now, if anyone, follows me long enough, I do this intermarket analysis, but I also do a lot of pattern recognition on anything. I don't care what it is. So here's my pattern recognition of Head and Shoulders potentially coming into that 4.2 level. Yes, cherry-picked indicator overlaid with the Fed funds rate, right? And this typically is a precursor to cuts, period, right? Whether it was 2018 and Powell tried to get them higher and Trump said, no, you don't, and ended up cutting, or whatever, 2007, 2000, and it doesn't matter. You can see the kind of the rollover in the 2-year, which is what the Fed has sway over. Thoughts on this chart in kind of correlation with what we're talking about right now. September, they come and cut. where do we go from here?
Yeah, look, I think we're more, my view is that the economy is slowing and that the Fed needs to be thinking about bringing rates down probably more aggressively in order to, if they want to arrest that slowdown, but they can't because inflation is still too high. And there's certainly risk that financial conditions would loosen much more materially when they start, and that, inflation expectations would move higher and there'd be a real problem. Look, the Fed they've created a mess. So I think that the economy, what's going to wind up happening is the economy is going to slow more protractedly is that a word? More rapidly in the next few months and quarters, and it's going to force the inflation numbers will look a lot better, and the Fed probably will need to and will be more aggressive cutting earlier in 2025 in order to arrest the growth declines. So
Okay.
I think we're there. And September is probably a good a time as any to start, but it won't be enough. And so basically, what I think what ends up happening is I think that winds up being a sell the news. When the Fed cuts in September, it winds up being a sell the news event, because then the market's going to say, "Cool, what's next?" And if you're not going to cut again until December, and you're only going to cut every quarter, it's not it's going to take too long for the benefit of a rate cutting cycle to actually filter through into the economy. In the meantime, folks are still getting, creamed by inflation or losing their jobs. And so, that rate cut doesn't, winds up not doing anything.
Okay. I have a picture of gold. James is asking for both still long gold. I think this is, and I posted this months ago. You were way before me. I think this is the most bullish chart. I have a very bearish chart, which is RSP to SPY, and I have the most bullish chart, which is this is a silver gold ratio on a monthly, so it's big picture. I think we're kind of early innings, stopped going down, but it was really this level of the March 1st freak out, and we talked about this. Gold is the new bond, right? As it relates to central banks. So you can talk a little bit about your macro reasoning for that, but just from an intermarket standpoint, this is the high that we had back in September 2011. And this, again, is a ratio of silver and gold. And with elevated, by the way, pricing in the underlying gold and silver, miners are just killing it when it comes to earnings. So I am very bullish miners still, and gold and silver, although I was expecting a little bit of a pullback. We never got it. Let's talk about Trump as it relates to the gold trade and your positioning on gold.
Yeah. Look, I'm still long gold. And I think gold checks, several boxes, from it being reintroduced as a neutral reserve asset to settle trade in BRICS, and excess reserves being stored in gold rather than U.S. Treasuries. I think that's a fundamental underlying story that just gathers more momentum every day that goes by, and every day that more trade is done away from U.S. dollars. So that is the base behind everything. It's being reintroduced, into the global monetary order. And look, I think if you believe that no matter who's elected, the U.S. is going to have deficit issues from now until forever, it just makes the case for owning and storing wealth in long-term U.S. Treasuries, that much less. And so I think gold really can continue to benefit from that. Gold also anticipates the easing cycle, right? Because it basically anticipates the need for the Fed to add liquidity to the system in order to arrest the decline in the economy. And so I think gold,
it loves loose monetary policy.
Yeah, so gold anticipates that cutting cycle, and gold can really start to move as the cuts start to accelerate. So I think we are, we're in the kind of sweet spot really for gold. The way gold wouldn't work, it is just kind of more on tactical if and when it gets overbought, or if we have some deleveraging events over the course of the next few weeks and months where people need to sell what they have, not what they want.
Yeah, that's different.
Gold could get, rinsed in those settings. I mean, I remember you could look back in 2008 on that chart. Before
Oh, sorry.
before it rallied in, starting in the fall, it had a couple wiggles where people were, really struggled with holding gold. It's kind of before that spike. So, but the case to me, makes sense. And as far as silver is concerned, look, silver it's demonetized in my view. There is no, I don't believe that silver is used as a store of value. I don't believe in silver will ever be reintroduced as currency or as a way to store wealth. I think silver is an industrial metal that goes into a variety of very good and strong growing underlying end markets. And so, I think you want to own silver over gold when you believe in a PMI recovery story, in a China manufacturing story, and a global growth reacceleration story. I don't believe those things are in play right now. So I think you have gold over silver kind of continues to work, and silver will work, I think, when we're kind of later into the cutting cycle, when there is more evidence that the economy is or is about to bottom, and companies are looking to start accumulating inventory in order to anticipate production growth and manufacturing growth. So to me, I'd rather own gold over silver. I mean, broadly, I think you want to just, as an asset class, I like owning commodities over fiat currencies, but really, I think you benefit just by having gold. You don't really need everything, everything.
Okay. And asked about, if I can see, some target area pricing. So let's real quick and then we'll close because it's kind of late. Just noticing that. All right. So let me just grab this real quick. Where's Q&A? Sorry, I closed it on you. All right, downside targets and all that jazz. So first we have to, where are we? Let me just post this, which I have shown before on occasion, which is my MAG 7 chart. All right, so I go over this with clients every day, but basically I have shown this in the webinars that we have done, which is basically a fib thrown onto the MAG 7. And I have this annotated for clients, inverse head and shoulder and the March, bailout, all the way to the Fed pause, Fed November 1st pause, Yellen Yahtzee to NVIDIA earnings. Anyway, the point is, this has been very, 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 very bullish. Just recently, we didn't go up to my tag you're it level. We actually have pulled back very, very strongly on this weekly for this MAG 7. I still think we're going to go tag it. So I don't think we're done going up, just to clarify. I think we got this very strong factor rotation that came in. And one of the ways that I track this every single day, again, for clients in every single way, is just growth value rotation. So this was a chart that I had been spying and then warned about specifically Monday, Tuesday, Wednesday of last week, did lots of write-ups. But the point is, this is your growth to value rotation in a nutshell. And we literally turned very sharply right at a level where the Qs were coming into this 504 level. So basically I have this 504 level as a tag you're it. We should get some shake and bake. And then specifically, this is growth to value. When is it safe to buy NASDAQ puts? When is it safe to buy puts in MAG 7, Meta, right? Microsoft, Google, NVIDIA, even NVIDIA. So it works really, really well. This is where we were this morning, or not this morning. Yes, 17th, which was last night. I posted this. We're not even quite back down all the way to where I think we get a very durable counter trend bounce. And this hedge fund rotation, to me, looks more likely that it's done. But this happens to be, I don't have it highlighted here, but clients know, this is November 2021. So this ratio went from the January effect, all the way through the March bailout in 2023 to NVIDIA earnings in 2023. We went hot fire flames. Anyway, long story short, November 2021, we basically are coming back down to that level. Then we'll see. So just to kind of clarify, the bearish chart that I also posted for clients early last week was this RSP to SPY, which you can see is very much concentration risk up here, right? And this is your equal weight. You've got it in breadth destruction and NYSE or NASDAQ, the oversold tech, or equal weight SPY. You can do this with any of them, but basically you put it together with a ratio, and you could see where RSP relative to SPY was on the ground. How far buried in the ground? Well, below the 2020 COVID lows. This is the 2020 COVID lows. It actually took out, and I had even put on Twitter, it took out, you can't see it here, but I have a bigger version of this. It took out the 2009 lows. It cut through like butter, and it took and broke through the 2003 lows relative to SPY. Why? Because this stuff has all that those leveraged ETFs, right? Craig and I talked about this last time as well. We've had a reflexive bounce. I haven't updated it. This is from the 16th, but you get the idea. We've had a reflexive bounce in RSP to SPY. We still have a lot more room that this could actually converge over time. But for right now, I think the bulk of this factor rotation is coming into a strong bounce area. And probably options expiration is going to kind of help that out. Anyway, this is great that we get together. I don't want to go too late. It is considered the power hour, and we're a little bit over. And yes, Craig is traveling with his cats and his dogs and his wife and his children. And it is just, oh my gosh.
It's a lot.
But,
I said it's a lot.
But long story short, really grateful that we could do this because he's going to be, again, out next week at the Bitcoin conference. And I think we hit all your questions of importance. I think we, played the bull bear perspective for a little bit and kind of weighed the importance of the Trump betting odds. But long story short, we had a hell of a standard deviation move in small cap over large. Now let's see. Now let it retest. Let it see if it can really withstand that breakout. And by the way, for those who follow closely, I said small IWM, $212.25 was the level it needed to get and stay above. It ran all the way to 226. So when we do pull back and test this, it needs to hold above 212.25 on a weekly in order to be a really durable trend continuation. Okay, that's all we got. I wish you a great afternoon, continued safe travels.
That's good. Thank you.
All right, cheers.
All right,
Bye.
bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.